An $8 billion corporate acquisition is one stroke of a pen away from closing. Outside the conference room, the media is waiting. Investors have the champagne chilled. The paperwork requires exactly one more signature. And then, the pen is deliberately placed down. Reaching a closing day like this requires massive logistical machinery. It involves months of negotiations involving investment bankers, law firms, tax advisors, and external auditors, all working across dozens of departments with a singular obsessive focus: finish the deal. This chart illustrates a psychological trap called deal momentum. As a transaction accelerates toward a closing date, it absorbs massive amounts of time, capital, and reputation. This heavy investment often shifts the team's perspective. They stop weighing the merits of the deal and start focusing exclusively on how to force it across the finish line. In this boardroom, a single senior legal counsel halts that momentum. He refuses to sign, asking the executives for one more review. To the bankers and the CEO, stalling an $8 billion acquisition hours before the market opens looks like immediate career suicide. But in corporate environments, disaster strikes when the collective pressure of a deadline becomes louder than individual logical scrutiny. Due diligence functions as a forensic hunt for invisible risks. An experienced lawyer reads a contract to imagine the catastrophic consequences hidden between the lines of standard legal prose. Look at this split-screen comparison. On the left, the company declares no undisclosed liability. On the right, a hidden subsidiary contract contradicts that. If a problem activates, the acquiring company inherits it endlessly. This leak drains the entire asset pool. Refusing to accept a blind spot, the legal counsel demands direct clarification from the target company's external legal team. He intentionally stalls the paperwork, letting the clock tick down to the morning market bell. Corporate governance dictates a specific rule for risk inheritance. Executives can mathematically price and accept a known risk. Signing a contract with unknown risks is an act of gambling, not leadership. The boardroom erupts in pushback. Finance argues the risk is low. Business executives cite millions already spent. Bankers warn of disastrous market signals. This funnel illustrates the behavioral economics dominating the room: the sunk cost fallacy and confirmation bias. The executives' desire to close the deal causes them to aggressively defend their trajectory, bouncing away red warnings while only letting deal-supporting data pass through. Then, late that evening, a 2-page email reply arrives from the catastrophic company. It confirms an active, undisclosed regulatory investigation into that vaguely mentioned subsidiary. This omission wasn't necessarily intentional fraud. Without publicly available facts, you can't assume malice. But the lack of transparency broke the essential trust required to legally inherit another company's future. Catastrophic corporate failures are rarely caused by a lack of data. They happen because of selective attention driven by intense psychological biases. The CEO cuts through the boardroom's bias by asking a single grounding question. If this were my personal company and my own money on the line, would I sign this today? The room goes silent. Stripped of their spreadsheets and presentations, the board swallows their pride. They defer the closing date and walk away from the immediate pressure of the deadline. 3 weeks later, the board reconvenes. Armed with complete transparency, updated disclosures, and a clear view of the regulatory landscape, they sign a heavily revised, protected, and far more stable deal. Corporate negotiations center on securing terms that ensure a company can survive the consequences of a signature. An effective legal team focuses on making a deal survivable. Every board member and executive must remember this principle. Never confuse urgency with necessity. Sometimes a leader's most profitable action is the signature they refuse to give.